Deputy Murphy.
Thank you, Chairman, and thank you, Mr. Moore. Just to continue on from what the Chairman was raising with you in relation to valuations, when you come to make a valuation on a commercial property, what are the main factors you're taking into account, apart from the potential rent that might be earned for the client?
Okay, I think the first thing is that it's an opinion, and it's an opinion of market value at the date of valuation. And it's important that it's done at a specific date as well, because obviously property is not a static asset, it changes. So it is only a snapshot in time. It's our best assessment of the open market value that will be agreed by a willing seller and a willing buyer acting without compulsion, and that's the definition that's contained within the rep book, as it were. It has to be based on an appraisal of evidence of current sale prices, current rental values, current property yields, of real transactions in the marketplace at the time, and it must use the most up-to-date and relevant evidence for the specific property involved. We then take that evidence into account. We adapt it for location. We adapt it for the size of the property. We adapt it for the type of the property. In an investment, we'll analyse the length of the lease. We'll look at the strength of the covenant. Does it have the ability to pay the rent? What is the potential for future rental growth? Is the property itself over-rented or under-rented? All those components are taken into account, and that will deal with most investment values. Development land values are slightly different. We use an approach which is called the residual valuation approach. What we do there is we estimate what the completed value of the development will be, less the cost to bring it there, and that will generally give you the residual value, which should be the land value. We'll test that then against market evidence, which will be what value per square foot is being paid for sites, what value per acre is being paid for sites. That's the general process.
How do you calculate a fee for that work?
The fee on that work is either a fixed fee or it's based on a percentage of value. The percentage of value has tended to fall away, and it tends to be fixed fee at this stage.
And when you say percentage of value in terms of what?
So if you have a property worth €1 million, scale fees, when they existed, which they don't any longer, used to be 0.2% of value. So that would be a €2,000 fee for €1 million valuation.
But that doesn't exist anymore?
No, fees are generally done by negotiation now, and they're generally fixed.
Generally fixed, okay. And in a transaction, can you work for both sides in the one transaction?
No, not unless we declare a conflict of interest and both buyer and seller are willing to abide by that. We generally don't, as a rule.
Okay. And when someone pays in excess of a valuation that you've provided, does that mean that the property has been undervalued, or the purchaser is overpaying?
Could be either. No, I think, without being flippant, I think obviously when somebody buys an excessive valuation, they have seen something in that property which is more valuable to them than perhaps anybody else in the marketplace. And so they see some significant, particularly can happen around land value, where people perhaps assume a higher density that can be built on the site than perhaps you've assumed in your valuation, or perhaps they've assumed a lower building cost than you've assumed in your building costs. So land value per se is volatile and can move around. With investment value, you'd be disappointed if your valuations were being exceeded all the time in sales. One thing that is important to understand, though, is valuation is backwards looking. It's not forwards looking. So values are based on the most recent previous evidence. So if a buyer wants to make a market by paying more, he's entitled to do so. And again, it's vitally important that it's understood that we're not market makers.
And this idea of moving to the fixed fee, when did that occur? Is that a recent development?
No, it's probably happening in around the big 2002, 2003. Fee levels were changing completely at that stage.
Okay. And why was the shift away from percentage of value to fixed fee?
I think people just felt it was primarily led by the banks and the developers themselves, saying we're not paying you a percentage. We just want to know exactly what we're being paid here for.
Okay.
And the professional bodies, I think, were happy enough with it, because it meant that there was absolutely no risk of somebody trying to increase the value to increase their fee. So it suited everybody from everybody's perspective.
Okay. And when you say that the valuation reports are not forward-looking, but you also go on to say that in 2007 and 2008 you began to advise clients to sell. Are you not doing that based on a fear of a future fall in value?
Not in a valuation. That would be in general property advice that we would be giving to people where we would be talking to them about pricing the prospects for their assets, or otherwise we will give forward-looking advice. But a valuation does not give forward-looking advice. It's set at that date and time.
Sure, but just to clarify this, you said evaluation at a particular point in time, but you're aware of risks coming down the line. Does that not affect then the valuation that you're setting? Do you not have to take that into account in some way, even if it's just looking at future rent yields?
As I said, that's why valuations are not forward-looking. And I think it's really, really important to understand that a valuation is set at that particular time. So, do we, in calculating the investment yield, will we look at the prospects for the future rental growth? Will we look at the prospects for the property? Will we look at the duration of the income? Absolutely we will, and we'll take that yield and we'll start to adjust that yield. But what tends to happen in real estate in particular is it's a lagging indicator. So generally what happens is by the time you make those projections, a transaction will have happened already, which will have set a new benchmark, which quite happened. So you've got to take both the evidence into account that you have, but you've also then got to make your judgment calls as to how you think the property is going to perform. But that will relate purely to the yield that you've chosen.
Okay. I might come back to that if I might in
Sure.
just a moment, but I wanted to look for a second at valuations and then your relationship to financing and investment and where the money is coming from. Because you said in your submission that on page 5, the practice of borrowers giving personal guarantees to secure debt became increasingly common in 2006 and 2007 and led to significant cross-collaboration of debt. So what would your relationship be with the funding of a transaction? You say you introduce parties.
We don't. I think that might be open to clarification. Like we don't introduce parties per se to banks or otherwise. That's not part of our role. We have no involvement in the debt markets whatsoever. So obviously we would know what would be going on when somebody is buying a piece of property. We understand and realise that they go to the banks to seek their funding. Mm-hmm. What became very, very clear, and some of this is with the benefit of hindsight, is that personal guarantees became quite common in 2006 and 2007 in particular. And what that really meant was, I think, banks started making their lending decisions based primarily on the apparent net worth of the borrower rather than actually the real underlying value of the security. And I think that's one of the issues that we had. Those personal guarantees meant that the lending practices started to look away from the actual real estate itself and relied.
Even one point there, just to have
Sure.
in your statement on page 5 there, Mr. Moran, it's under the heading Sources and Extent of Funding and Commercial Real Estate Market in Ireland. In that comment you say, while we may introduce parties, which I think is what Deputy Murphy is saying, you're on the record saying you're introducing parties, so maybe you can just clarify that, Mr. Murphy.
Per se, like, I mean, if I'll describe it perhaps, and that describes it. If a client comes into our office and doesn't have a banking relationship, we'll say to him, you can go and talk to Mr. X, Mr. Y, or Mr. Z of a particular bank. But that's as far as we get involved in it, so that's for clarity.
I'm interested in that because in terms of the transaction point, someone's come to you before they've actually got the financing to make an investment in something that you're managing.
Not necessarily. No. We provide two services when it comes to investment property. We sell investments, and we also provide buy-side advice. So when somebody comes into us and wants to buy an investment, they'll either be fully backed by equity, or they'll say to us, we're going to use debt as part of this transaction. At that moment in time, we'll turn around to them and we'll say, well, if you're going to use debt, we don't do debt advisory, we don't provide any corporate finance advice. You need to go and talk to a bank.
Mm-hmm. But it's typical that someone would come into you for a big transaction, which I imagine it would be given the size of your company, and that they wouldn't have already negotiated a position with the bank.
The vast majority of people already had their banking relationships in place long before they came to us. Yeah.
And would your company have a particular relationship, or would companies like yours have particular relationships with particular institutions or banks for that? Okay. And just to clarify, when you were talking about the practice of personal guarantees, that's a hindsight view. That wasn't, you weren't aware of that at the time?
That was a hindsight view.
But would you have had any particular concerns about individual investors as to their exposure, say, given your view of the market in its totality?
You would have had a concern that, particularly towards the end of 2007, when you could start to see values weakening, that if lending decisions were still being made at that time on the basis of personal guarantees, which were underwritten by the personal net worth of those borrowers, that perhaps the they would have become and started to look more risky.
Okay. And what about syndications then? Because you mentioned that they were a significant part of the market at the time. Would you be involved with putting together syndicates or helping people?
What we did for syndication, basically, just to describe it, so again, everybody understands exactly how it worked, was there were a variety of people. There was private syndicators, there were private wealth managers, there were the stockbroking firms, and there were the private banking arms of the banks, which effectively pooled together private investors to pool together their equity to allow them to buy larger assets. Those assets would have been out of the individual's reach in terms of their size and their scale. So they pooled the equity together, they put debt in behind it to support those type of transactions, and then proceeded to acquire. And coincidentally, that started in the Financial Services Centre in the mid-1990s, where a lot of syndicated deals were put together to benefit from what were quite attractive tax allowances, then continued into 2000 onwards. We don't involve ourselves in syndicates. We were never put together any syndicates. Our job with regard to any private syndicate was to advise them on trying to find opportunities for them, and if they were successful in buying them, to do the due diligence for them on that transaction.
Okay, thank you. I'm going to move on just quickly to risks and indicators, because my time is kind of vanishing for some reason. But you became increasingly aware of risks in the Irish commercial property market. Would you have expressed or reported any of those fears? Would you have discussed that with other players in the property market? Would you have spoken to government about those risks or fears?
We didn't discuss it with government. Throughout my entire time in that period, there was no approach made to us by anybody from government as to what our views were on the market, which, with the benefit of hindsight, we found maybe slightly unusual. We would have expressed our concerns and our risks with our client base, because that's who we have our duty of care to. We publicly, I think in about March 2007, my research team would have publicly stated that we were cautious about the market and that the market required a significant amount of caution at the time. So that's when we started publicly making statements about it.
In 2006, there was a number of significant sale and leaseback agreements, quite a substantial size. What's that telling us at that point in time?
Point in time, I think the sale and leasebacks, I think, which were primarily by the banks themselves, were designed to provide Tier 1 capital to them so that they could continue to lend.
That's how they explained it, but thank you. Would you agree with that explanation?
Yes.
At the time, there wasn't fear over future values and trying to capitalise on a position.
I was involved with all of those, so I can assure you that was the reason behind it.
Okay, thank you. I want to look at a specific case, if I may, in relation to Athlone Town Centre, because I think it's an interesting one. September 2007, valued at 345 million. The Irish Times at the time says it will be the second major shopping mall in the town and has raised questions about whether the local population is large enough to sustain both. In February 2015, it was being valued at 60 million. What's happened there? I mean, that's not a small overvaluation. That's not that's a significant change in value. And even though in 2007, when your company would have been aware that there was risks in the market, and the Irish Times itself, so people were aware that this might not have been actually sustainable as a development, it's valued at 345. And then in 2015, it's valued again at 60 million.
I don't think it was valued at 345 million in 2007. That's the first thing. There was a transaction agreed, which is not a valuation, it's a transaction, which never concluded. So the